Hey everyone, welcome back to the channel. Today, we're diving deep into a term you hear all the time, especially when the economy gets rocky. Money printing. It conjures up images of giant printing presses churning out stacks of cash, right? Well, the reality is a lot more complex and, honestly, a lot more interesting. Stick around because we're about to bust some major myths about how money is actually created in our modern world. So, when politicians or news anchors talk about the central bank printing money, what are they really talking about? It's not about physical cash. In fact, most of the money in our economy isn't physical. At all, it's digital. It exists as numbers on screens, in bank accounts. The vast majority of new money created today is electronic. Let's start with the main player, the central bank. In the United States, this is the Federal Reserve, or the Fed. In Europe, it's the European Central Bank. These institutions are the ultimate source of a country's money supply. They have a unique power. They can create money out of thin air, but they don't just do it on a whim. They do it with specific goals in mind, mainly to keep the economy stable, control inflation, and keep employment high. So how do they create this digital money? The primary method is something called open market operations. It sounds complicated, but the basic idea is simple. The central bank buys financial assets, usually government bonds, from commercial banks, the banks you and I use every day. Imagine your bank, let's call it Main Street Bank, owns a bunch of government bonds. A bond is basically an IOU from the government. The Fed decides it wants to inject more money into the economy, so it goes to Main Street Bank and says, "We'll buy those bonds from you." The Fed pays for these bonds by simply crediting Main Street Bank's reserve account at the central bank. Poof! New money has just been created. There was no printing press involved. The Fed just used its keyboard to increase the numbers in Main Street Bank's account. Now, Main Street Bank is sitting on a pile of new digital cash. This is called bank reserves. What can it do with these reserves? Well, it can't just hand them out to people on the street. These reserves are the basis for lending. With more reserves, the bank is more willing and able to lend money to individuals and businesses. When you take out a loan for a car, or a company takes out a loan to build a new factory, new money is effectively created and enters the wider economy. This is how the central bank's action trickles down. By increasing bank reserves, they encourage more lending, which stimulates economic activity. This brings us to a huge topic you've probably heard of, quantitative easing, or QE. This is basically open market operations on steroids. During a major economic crisis, like the 2008 financial crisis or the recent pandemic, normal open market operations might not be enough. So, the central bank goes on a massive buying spree, purchasing not just government bonds but other assets too, in huge quantities. The goal of QE is to flood the financial system with liquidity, that is cash. This does a few things. First, it pushes down long-term interest rates. When the central bank buys lots of bonds, the price of those bonds goes up. And when bond prices go up, their yields, or interest rates, go down. Lower interest rates make it cheaper for businesses to borrow and invest, and for people to buy homes and cars, hopefully jump-starting a sluggish economy. Second, it boosts confidence. When the central bank steps in with such massive force, it sends a powerful signal to the markets that it will do whatever it takes to prevent a total collapse. This can calm panic and stabilize the financial system. Now, the big question on everyone's mind: if the central bank can just create money, why doesn't this lead to massive inflation? It's the classic case of supply and demand. If you dramatically increase the supply of money while the amount of goods and services in the economy stays the same, prices should go up. Each dollar becomes less valuable. So why didn't we see hyperinflation after the massive QE programs of the last decade? There are a few key reasons. First, a lot of that newly created money never actually made it into the hands of consumers. It stayed within the banking system as excess reserves. The banks, cautious after the crisis, didn't lend out all the new money they received. They just held on to it. If the money isn't being lent and spent, it doesn't chase goods and services, so it doesn't push up prices. Second, the economy was very weak. When QE was implemented, we were in a deep recession. There was a lot of slack in the economy, employed workers, idle factories. So, even as demand started to pick up, thanks to the stimulus, the economy had the capacity to produce more goods and services to meet that demand. The supply of stuff could grow along with the supply of money, keeping prices stable. This is a concept called the output gap. And third, there's psychology. Inflation is also about expectations. If people and businesses expect prices to stay low, they behave in ways that make that happen. They don't rush to demand higher wages or raise their prices. For a long time after 2008, the fear was deflation falling, prices not inflation. So the expectation of high inflation just wasn't there. However, the situation recently has been different. The massive stimulus during the pandemic was combined with direct payments to people and businesses, not just bank reserves. At the same time, global supply chains were completely disrupted. So you had a situation where a lot more money was chasing a lot fewer goods. That's a classic recipe for the kind of inflation we've seen lately. It shows that money printing can indeed lead to inflation, but the context matters enormously. It's not an automatic process. So, let's recap the myth busting. Myth 1. Money printing means running physical printing presses. The reality is, it's almost all digital, created by a central bank crediting commercial bank accounts. Myth 2. Creating money always causes hyperinflation. The reality is, it depends on what happens to that money. If it stays stuck in the banking system, or if the economy has lots of room to grow, inflation might not be a problem. The velocity of money, how fast it changes hands, is just as important as the quantity of money. And, myth 3, the government can just print money to pay for all its spending. While technically a government could try this, it's not how it works in most developed economies. The central bank is typically independent of the government's day-to-day spending decisions. The Treasury, which handles government spending, has to raise money by taxing or borrowing, by issuing those bonds we talked about. The central bank might buy those bonds later on the open market, but it's an indirect process. This separation is crucial to prevent politicians from printing money uncontrollably to fund their projects, which historically has led to economic disaster. Understanding how money printing really works is key to understanding modern economics. It's not a simple on-off switch for inflation. It's a complex tool used by central banks to navigate the ups and downs of the economic cycle. It involves balancing the risks of recession against the risks of inflation, and the effects can be unpredictable. Depending on the state of the economy, the behavior of banks, and the psychology of all of us. So the next time you hear someone say they're just printing money, you'll know the real story. It's a tale of digital reserves, bond markets, and the delicate dance of managing a multi-trillion-dollar economy. It's far from simple, but hopefully it's a little less mysterious now. Thanks so much for watching. If you found this explanation helpful, please hit that like button and subscribe for more deep dives into how the world really works. Got questions? Drop them in the comments below, and I'll do my best to answer. See you in the next video.